Hi guys, welcome back to the channel. My name is Priyam and I'm a trader. As you have already seen the thumbnail, in this video we are going to discuss everything that you should know and every new trader who's coming to stock market and choosing day trading as a full-time career should know about. In this video, we are going to answer several of the questions about day trading, like what is day trading, how can you become a successful day trader, what are the strategies you can use in day trading, what is the psychology of day trading, what is the psychology behind this business involved. We are also going to discuss why 90% of the day trader fails in stock market. I am at the end of this video also going to provide you the setup that I use for my daily analysis and trading. We are also going to talk about risk management, stop loss, the importance of these three, position sizing and everything in this video. So without wasting any much of your time, let's straight dig into the video. I have made a special PPT for you all guys for the better understanding of what is day trading. So let us get into the laptop screen now. Alright everyone, now you are looking at my laptop screen and to the presentation that I have made for you all guys. So this is the very first page of the presentation, Day Trading for Beginners by Priyam Sharma, day trader, 3 years of stock market and trading experience, founder of the channel Power of Pivots. So without wasting any much of your time, let's dig into the video and to the very first question, what is day trading and how does it works? Day trading is a form of speculation in which a trader buys and sells a particular stock or index within the same trading day. So what does this mean? It means that when the market opened at 9:15 a.m. in the morning, according to your setup, whichever setup you are using, you took the trade and before the last bell of the market rung at 3:30 p.m., you exited all your positions. That means before the market closed, you exited all your positions. Either you were in a loss or profit, you will exit your positions and accept what the market had given to us. Either it is a small loss, a small profit, a big loss or a big profit, we will accept it and wait for the next day of trading. Now this is what day trading is all about. So day trading is completely different from swing trading and positional trading. So let me give you an example for this. A swing trader holds his winning trade for a week or so from the day the trade was taken, whereas a positional trader holds his winning trade for a month or so from the date when the trade was taken, whereas a day trader exits all his positions within the day itself. So this is the initial difference between day trader, swing trader and positional trader. Now the question that comes in the mind of the people that why not a day trader takes overnight positions. Now the answer to this question is to avoid any unmanageable risk and negative price gaps between one day of closing and the next day of opening price. It is often seen in the market that market often open gap down and gap up. Now this gap down and gap up can occur due to some event, some big news in the market or due to some global market news. Suppose you are long on a particular stock or on a particular index, and if the market opens gap down, then your profit earned yesterday will be converted to loss and the P&L will show red at the starting of the day itself. So to avoid such unmanageable trades and unmanageable risk, we day traders do not take overnight positions. What we do is we buy a particular stock which we think will go up, and if it goes up we make money. We sell a particular stock and if it comes down we make money by short selling. But the point is how to know when will a particular stock will go up or down. Now to understand where the stock will be going, we use technical analysis for day trading and fundamental analysis for investing. Now I have already made a video on the basics of stock market where I have explained technical as well as fundamental analysis in brief. I will be providing you the link of the video in the description section. or in the I button or at the end of the video. I have already discussed and explained the difference between swing trading, positional trading, and day trading. Now, let us come to the very next question, that what is the difference between day trader and investor? So, difference between day trader and investor. A day trader is a short-term trader and he will buy or sell a stock within the same day in between 9:15 a.m. to 3:30 p.m. Whereas an investor is a person who invests in a particular stock or index for a long-term period. Once he or she buys a particular stock or index, they keep it for a long-term period like 5 years, 10 years, 15 years, 20 years, and as much as long as they want. The second difference is a day trader makes his decision based on technical analysis, whereas an investor takes his decision based on fundamental analysis. Now, technical analysis is just the forecasting of the price based on the previous data available to the trader, whereas fundamental analysis includes the balance sheet of the company, the debt to equity ratio, the quarterly results of the company growth from the past few years. So these are some fundamental analysis, and a good trader always have a very good hand on fundamental analysis. The third difference is a day trader gets leverage on day trading. Of course, because of the new margin rule, the retail traders are not getting margin nowadays, but if you trade in the cash market, you get margin in the cash market. Whereas if an investor have to invest in a particular stock or index, no margin money is given to him. The complete margin the investor has to bring by herself or himself. The fourth difference between the day trader and the investor is that a day trader make money if the stock goes up or if it comes down, whereas an investor only makes money when the stock goes up. Now let us discuss about the strategies and trading tactics that different trader uses. So different trader uses different type of strategies in their trading arsenals. Some trader uses technical indicators like MACD, moving average, RSI, CCI, and stochastics, etc. for their trading. Now there are two type of technical indicators. Number one is leading indicator. Number two is lagging indicator. There is a community of trader who uses only and only leading indicators for their trading. Whereas there is also a community of traders who uses only and only lagging indicators for their trading. While there are few traders as well who prefer a combination of both leading as well as lagging indicators for their trading. Some trader uses data like open interest, option chain, and then they take positions. Now, option is a derivative of an underlying asset, and every underlying asset have a option change. Now, traders uses this option change for finding the most demanded option in the chain, and then they trade that particular option with the help of the chart. Some trader uses option Greeks as well. Mostly option seller uses this because of the sole advantage of theta decay. Some traders are pure price action based traders. They use reversal pattern and continuation pattern for their trading. Patterns like head and shoulder, inverted head and shoulder, double top, double bottom, triple top, triple bottom, bullish flag, bearish flag, symmetrical triangle, ascending triangle, descending triangle, wedges, paynets. There are numerous number of patterns that occur in the market very frequently. So pure price action based trader uses these price pattern for their price production. There's a saying in the market that 95% of the day trader fails in stock market and only 5% trader make money from day trading. Why is this so? Let us understand why most of the day trader fails in stock market. So, according to me, there are three main points why most of them fail are: number one, emotion; number two, not having a good back tested strategy; number three is risk management. So, a trader who trade on emotions rather than following the rules often find themselves making big losses and even wiping out their entire capital. Traders who take decisions based on emotions like fear, hope, and greed will never be successful in this business because controlling and handling your emotion is the only monopoly that works in stock market. The second point is not having a good back-tested strategy. Day trading requires a good back-tested strategy. Many new traders enter in the business of stock market with the hopes of making money but without any good strategy and often make big losses. The third point here is poor risk management. Now, risk management is one of the most important thing out there in the market. It helps you to cut down losses. It can also help protect traders' account from losing all of its money. Risk management is all about knowing how much a trader is risking in each trade and understanding the right position sizing in every trade. Now, let us talk about the psychology involved in this business. A trader with a proper psychology will always make money in this business rather than the trader with improper psychology. Here are some qualities that an experienced trader with proper psychology will possess. He will always know when to average a trade and when not to average. He will follow a good risk management. He will always have a good risk to reward ratio. He will never fight with the market. He will always take his stop loss without blaming the market, and he will never do over trading. Now, these are some qualities that an experienced, good, proper psychological trader will possess. Now, we will discuss some of the psychological mistakes that every new trader do in the market. The first one of it is overtrading. Now, there is a mindset of every new trader that now that they are into trading, they have to take trades every now and then and every day, which is completely wrong. It is often seen that a new trader who make losses in their initial stage, they keep on taking trades in the hope of making profit but end up making big losses. Now this is one of the most disastrous effect of overtrading. Whenever you overtrade, you end up making even bigger losses and even wiping out your entire capital. The second biggest mistake that every new trader do in the market is FOMO, fear of missing out. Always remember that when a trade in a particular stock or index is gone, you should never chase that particular trade, because if one trade is gone, it does not mean that other trade won't come to you. But chasing that trade means calling for own self disaster. Trading out of frustration to cover out your losses is a sure shot recipe for disasters. There is a saying, a trader who keeps on averaging his losing trade is an idiot, and a trader who takes his stop loss when proven wrong is a smart trader. Now, this is one of the best quality that a proper psychological experienced trader will possess. Another very important factor in day trading is risk management. Risk management is all about knowing how much a trader is willing to risk in each and every trade and understanding the right position sizing in every trade. Now, when we talk about risk management, the first thing that comes into our mind is stop loss. Now, what is a stop loss? A stop loss is nothing but a buy or sell order for any trade that goes against your direction. Always have a stop loss in your trade. If your trade goes in the wrong direction, stop loss will take you out of that trade, protecting your investment and capital. Not placing your stop loss in the trade can even wipe out your entire investment as well as your entire capital in just one single trading day. So, having a stop loss is very important and the most important part of risk management. Never trade without fixed risk to reward ratio. Always have a fixed risk to reward ratio, that is 1 is to 2, which means for every 1 rupee of risk, you are rewarding yourself with 2 rupees. The next thing that comes to our mind when we talk about risk management is position sizing. Position sizing is nothing but the number of shares that a trader buy or sell in a particular trade. For example, if you do future and option trading, then SBI future one lot size is 1500. You can also say that SBI futures one lot position sizing is 1500 and HDFC Bank future one lot position sizing is 500. Now, the next thing you should know that you should never risk more than 2% of your entire trading capital in a single day. Let me give you an example for this. Say, if you are a new trader and you have a trading account of 50,000 rupees and you can only lose 2% of your entire capital in a single day, then you should only invest 50% of that capital in just one single trade. By doing so, you will only invest 25,000 in that single trade. And if you can lose only 2% on every trade, then you will lose 500 rupees, which is still only 1% of your entire capital. Your position sizing and stop loss should be so managed that when you lose in a trade, you will never lose more than 2% of your entire trading capital. Never keep averaging your losing trade. Take your stop loss and come out of that trade because that's what a good and experienced traders do. So now let us discuss my day trading strategy that I uses every day for my analysis and for making consistent profit from the market. So my day trading strategy involves floor pivots and CPR, central pivot range, combined with price action. I use 5 minutes and 15 minutes chart for my day trading. Now I use two indicators, that is exponential moving average 20 period and 8 period EMA. I use 20 period EMA for my entry signals and 8 period EMA for my exits or trailing the stop losses. I have been using this strategy for quite a long time now and have got really good results. I don't trade in commodities, binaries or forex or in cryptocurrency. I only trade in stock market. I am not a swing trader or a positional trader, so I do not take any overnight positions with me. Before the last bell of the market rung, all my positions are closed. As being a day trader, I am a technical analyst and not a fundamental analyst. If you have come this far watching this video, do give it a thumbs up, share with your friends so that our trading community can grow easier and faster. Subscribe to the channel and I will see you in the very next video. Until then, keep trading, keep earning.